Protect yourself against inflation by investing in debt. Hello, everyone, and welcome back to another episode at NOVARISE Invest, your channel for financial education. So today we're going to talk about inflation. I know there's a lot of polarizing videos out there, a lot of polarizing opinions. And so what I decided to do was just to create this episode that looks for ways, in-depth ways, to actually protect yourself against what's about to come. Because the truth is, we can't really do anything to stop inflation. That's completely out of our control. But what you can control is how you react to it by educating yourself and how you take action to protect yourself and not be an active participant of all that drama. That's what I have prepared for you today. So without further ado, let's get started. So to start off, I want to just reiterate that inflation is everyone's problem. Okay. You're not immune to it, regardless of whatever your financial situation might be, whether you are poor, whether you have some level of income, or whether you're rich. Inflation impacts everyone, regardless of your background. So I decided to create this episode to kind of like provide you with actionable items and also to educate you so that you can understand what's happening and to prove you that there are things that you can do to lessen the impact of inflation. This episode was specially created for those who are currently in retirement because at this point you're looking to maximize whatever income you might have from whatever retirement savings you have. So in order to level the playing field, I want to start off by going over some numbers regarding inflation because it's important for you to really understand the underlying concept of it. So as of the time of this episode recording, inflation is set to be at 8.6, right? I know you're watching this episode in July. Unfortunately, at the time of recording, the June numbers for inflation have not come out. So we got to work with what we have, which is, 8.6, right? So that means that in real terms, if you were to take a percentage out of it, out of 100 and you minus 8.6, that means your money in reality, it's only worth 91.4% of it. So how does that translate in value? So let's assume Chepito comes in. Chepito is our fictional character, right? We use him to talk about all kinds of different case studies. So Chepito over here has $20,000 saved, right? And in your eyes, that doesn't seem bad, right? 20,000, that's a pretty good deal, right? But that's just simply a number. That's just something that is nominal. It's what you see. And that's not really that important when it comes to the cost of living. The number that you should really care about is the real value of those $20,000, which means the value adjusted to inflation. So if we were to take Chepito's saving of 20,000 and we were to multiply that by what the real value is today at 91.4, and remember 91.4 came from here, that means that Chepito only has left the equivalent of $18,280. Yes, in your eyes, it looks like it's 20,000, but in reality, Chepito can only spend this much money, 18,280. That's the real value of his money. That means that his purchasing power has been reduced. That means he has less to play with. And as if that wasn't enough, things are getting expensive because of inflation. Rent is going up. Your groceries are going up. Gas, no doubt, it's actually going up. In other words, you can buy even less with that money. That is what inflation does to you and your money. But once again, you do not have to be a part of it. That's why you're watching this channel, because you're looking to educate yourself and you want to find ways to protect your money against inflation and the so-called recession that many are talking about today. You do not have to be a part of it. You still have control. So how can you protect your money against inflation, right? So let's talk about protection, right? Well, the first thing I will say is that you should invest your money, right? We wouldn't be doing justice to this channel because this is an investment channel. So, what are the things that you can actually invest your money on? Well, the very first thing, it's on your education. Very important. If you don't have financial education, you're bound to repeat the same mistakes over and over again. So, education should be your number one priority in terms of investing your money. And by education, I'm not talking about college or anything like that. I'm talking about developing a skill set, developing skills that are going to help you move forward, make more money without necessarily having to break your bones and break your back. Okay. Now, another way to invest your money, it's in real estate. We're a real estate investment channel, so I wouldn't be doing it justice if we don't talk about investing in real estate. However, this episode is not to talk about real estate in detail because we have a lot to cover today. But if you're interested about learning about how to invest in real estate the right way, here's a free webinar that you can sign up on. Yes, once again, it's completely free, and you can learn all about investing in real estate the right way without any money. Okay? Now, back to the board, and we're going to move on to our next item on the list. You can also invest your money in life insurance that will give you access to cash accumulation. For those who want to know more about it, here's an episode that I created where we cover the subject of life insurance. And this is also another episode that we cover a lot more in depth in our investment program. Now, back to the list. You can also invest in the stock market. However, investing in the stock market involves a lot of up and downs. And some of you might have the stomach to bear with it, but some of you might not. And what if you're in that position and where you no longer want to deal with the ups and downs? You want to find another type of investment that it's a bit more, let's say, stable, so to speak, right? And that's where fixed income comes in, right? So what the heck is fixed income? Well, it's very easy. It means income that comes at a fixed rate plus interest. And a great example of fixed income are bonds. And I'm pretty sure that up to this point, you have heard about the term bonds. I've heard about it for many years, but I actually never quite understood what they were. And with everything that's going on, more and more experts seem to be talking about investing in bonds. So I decided to just jump on and do a little bit of research and learn more about the subject, because up to today, all I knew was how to invest in real estate and how to invest in the stock market. But I didn't really look into the power of bonds and what it had to offer. And once I found out, I couldn't wait to share that with you. And here's what I have to share with you. So a bond is basically an IOU. It's a promise to pay. You lend somebody money, and that institution is saying, okay, thank you for lending me the money. I will give this money to you within 6 months plus interest, right? So in essence, it looks like this. So we have companies and we have governments who issue bonds, right? So they come here and they say, hey, please loan me the money, let's say $10,000. And in exchange, I'll pay you a 4% interest within 6 months. And so they go to the open market, they offer this to everybody. And people like Chipito, people like you, people like me, go ahead and we lend the money to them. And we wait a certain amount of period or a certain amount of time for us to get the money back plus interest. Now, I know a lot of people say that bonds are boring, that they don't really offer the same return as the stocks. And you're right on that. They're actually very accurate in that assessment. The stock market does offer a higher return for the long run, meaning if you hold your stocks for a long, long time. So investing in stock is not about getting access to money right away, unless you're a day trader, right? But for the majority of us who want to just simply park our money somewhere and know that it's safe for our future, for our retirement, for any emergencies, we appreciate stability, right? And given everything that's happening today, it's worth considering. And here's why. So let's say I want to show this to you with an illustration over here. So you have this graph right here. And we have different amounts. So let's say we have 100 over here, we have 75, 50, and yada yada all the way down. So let's say that Chapito comes in and he liked what he saw with the bonds and he decided to invest his money on a $100 bond, right? So if he holds it all the way until maturity, meaning until the date that he's supposed to get the money back, he will get back his bond money plus interest. But Chapito loves to diversify. And he also invested in the stock market. And he bought a couple of stocks at $75, right? So he has a portfolio starting off at 75, and then over time it grows, but then whoop, there's a reset, and then it goes up, and then whoop, it falls, and then over time it goes up again, and then falls a little bit, and it continues to go up. That's in essence what investing in the stock market means, right? So it overall it goes upward if you hold your stocks over the long run. But what happens if you were to need your money right here at this precise moment? Let's say you needed liquidity for your business, or maybe an emergency happened and you really, really needed to liquidate your investment, and all you have is stocks. It will really suck, because if you need your money at this point in time, that means you have to liquidate, meaning you have to sell your stocks at a loss. You bought here at 75, and in this case, Chapito bought here at 75, and now he has to sell at this point at a loss, and it's not nearly a fraction of what he originally invested. That's why it is important for you to balance things out with a more diversified portfolio that includes a combination of stocks and bonds. So in this scenario, if Chapito really needed to hold, he could just simply sell his bonds and he will get his original investment plus whatever he has accumulated in interest up to that point. Of course, certain circumstances apply. He might have to sell the bond at a lower price because of the demand. But let's assume things are relatively stable. The stock market just happens to not be doing well and he needed to liquidate, and his bond price remained relatively stable. So he can get his money out and take care of everything that he needs to take care of. This is extremely important to consider because the majority of us have invested in an economy that so far has been doing pretty good. But if you're from an older generation, let's say you're anything above a millennial, you probably would have seen the ups and downs in the market and you could agree with me. But anyone who's in a millennial or younger, we're not used to seeing the ups and downs of the market. Yeah, we might have heard of 2008, but did we really live through it, right? And so today we are in unprecedented times. We've seen a lot of changes in the market and we need to readjust our investment. If I have to put this in the sports term, investing in bonds, it's more of like a defense strategy, right? You are defending your money, you're protecting it, you're preserving your capital. While investing in stocks is more of like an offense strategy, because you're just basically pushing your money into the market and hoping to make money of it over the long run and let it grow, 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 grow. But I'm sure, as you've seen in the latest news, the stock market has been going on a rally and a lot of people are losing money right now if they choose to liquidate their portfolio. And you don't want to find yourself caught up in that situation. So what are the major benefits? Why will people or companies or the government want to offer bonds? And why will people, meaning you as the buyer or the holder or the investor, whatever term you want to use for yourself, will want to do this, right? So on the left side, let's just talk about those who are actually issuing the bond. So we have companies, right? We have corporate bonds, and these are typically issued because they want to raise capital, right? But they don't necessarily want to share that equity, because every time companies issue stocks in the open market, that means they are diluting their ownership. That means they have less control, less power, and they have to go out and ask all the shareholders to vote and yada, yada. It just, becomes a cumbersome process for them, as opposed to just simply coming in and issuing debt in the form of bonds. And they would just simply say, hey, I need you to lend me $10,000 and I'm just going to pay it back to you within 4 or 6 months, whatever the term is, at a certain percentage rate. It becomes a lot easier. So companies raise this money to, pay for their operating expenses. Sometimes they use it for mergers and acquisitions to buy out other companies. Sometimes they use that money to do, more research and development to improve their products. There are a bunch of different reasons why a company will want to issue bonds. But the point is they do issue them, right? Now, for the government, why would they want to issue debt? Well, very simple, because they're also trying to raise capital. Taxes is not the only way to raise money. Governments can also raise capital through debt by issuing bonds. In fact, there's a very interesting episode that I created not too long ago that talks about how the United States, it's, the best at the best at, playing around with debt. And I invite you to check out this episode right here after you're done with this one, of course. Now, on the right side, for you, for the buyer, why would you, in your right mind, buy a bond? Well, very simple, because bonds offer a quote unquote predictable source of income, right? Because anyone that holds debt gets paid first. You always come first in line as opposed to the shareholders. That's why banks can easily foreclose on your property, because they are debt holders. They're holding the debt that you owe them, and it's backed by your property. And if you don't pay the mortgage on time, they will just simply foreclose on your property and take the property back. That's why it's so powerful to invest in debt. Another reason why you will want to invest in debt is because it will help you offset the ups and downs, meaning the volatility of the market. You want to invest in bonds because sometimes, depending on the type of bond that you invest, those are actually tax exempt. And I'm talking about munis particularly, which is short for municipal bonds. And I will talk about munis more in details later in the video. And lastly, the most important reason as to why you want to invest in bond is, once again, capital preservation. Because the interest that you will be accumulating on the bonds will help you offset inflation. And here's what I mean by that. So once again, we covered that in the beginning. Inflation is currently at 8.6. But if you were to check out the bond rates in the market, the interest rates or the yield that they're currently offering could range somewhere between 0.24 to 8.197 at the time of this episode recording, meaning things could change depending on when you're watching this episode. And so what happened is, when you invest in bond, you get a certain interest rate. It could be 0.24 going all the way up to 4, 5, or even 8.197%, right? So that's not bad, because it's helping you offset some of the losses that inflation is creating on your money. Now, I know this might not necessarily help you make any gains, but it is definitely better than putting your money on a savings account. And in fact, I actually did a little bit of digging just to demonstrate that I wasn't kidding. Look, this is how much banks are paying for your savings. So if you were to create a savings account in Chase, you're only getting 0.01%. And I decided to do this check using different zip codes. And the first one I used Miami, thinking that, hey, maybe depending on the state, they change. But not really, because I checked into Citibank using a New York zip code, and things are actually the same. They're also paying 0.01% interest on your savings. They're paying you that much money, or better said, that little, for you to keep your money in their savings account, in their accounts, so they can take that money and loan it to someone else. For that, you might as well just invest in bonds. At least they're giving you a higher return on your money. Now, let's just talk about bonds in more details. But before we do that, if you're enjoying this episode, do not forget to hit the like button right here so you can help this episode rank and help others like you looking for information of this kind. So bonds, interestingly, they are kind of like people. Bonds also have a credit score, just like we, regular people have a FICO score. So the way these bonds are actually scored are as follows. And what I'm going to do is just go into the next page to get a little bit more space. So we have a score credit rating of AAA. Then we have AAA with smaller letters. And then we have BBB. Then we have BAA. And then anything that's below that, it's considered junk, right? So junk bonds. So what's the meaning of that? So whenever you see a credit rating of AAA, that means the bond is considered high grade. High grade means that they're very likely to be repaid, okay? And if you see a bond with a rating of triple B or BAA, that means they are considered investment grade bonds. And what it stands for is that they are unlikely to default. And then junk bonds, they do offer very good returns, higher rates than usual, but they come at a cost. They're more risky. So it all depends on your tolerance for risk, right? So what are some of the examples of bonds that could be deemed AAA or triple B, right? And so what I'm going to do is just to share a list with the different type of bonds with you that are ranking from the most secure, quote unquote, to the most risky. So it is no secret that government bonds are the most secure because they're backed by the US government. So we have Treasury securities ranking as number one. And there are three types of Treasury securities. So we have T-bills, they are T-notes, and also T-bonds. And the main difference between them is the time to maturity, meaning the time that you have to put your money in there, hold it, and then wait to get paid back. So for T-bills, you typically, depending on the type of T-bill that you buy, the holding period for them is 4 weeks, 8, 13, 26, or even 52 weeks. And you can invest with as little as $100. T-notes, on the other hand, are a little longer. So typically you have to hold them for either 2, 3, 5, 7, or even 10 years. And with T-bonds, we're talking about a 30-year holding period, all the way up to maturity. And of course, the longer the holding period, the higher the interest rate. And the shorter the holding period, the lower the interest rate, right? Because it's not the same to invest your money and know that you're going to get it back within 4 weeks or 8 weeks versus 30 years. In 30 years, a lot of things can happen and you just simply don't know. So in order to attract these type of investors, higher interest rates must be offered. The second one on the list will be municipal bonds. So municipal bonds are called munis for short, and they're the second, quote unquote, most stable type of bonds down the ladder. And munis typically offer the benefit of being tax exempt for those who have higher income and you're looking to generate interest that is tax exempt. However, keep in mind that when you're investing in a tax exempt muni, that means the rates or the yield that's offered to you, it's lower. And if you buy munis that are not tax exempt, of course, the rates are going to be higher. So you always have to keep that in mind. And next on the list, we have corporate bonds. So corporate bonds, again, how do you know that they are good? You go by their credit score, whether it's AAA, AA, and yada, yada. You also can get junk corporate bonds. But once again, keep in mind, if you're investing in something that is considered junk, that means the return is higher, but you need to ask yourself, can you stomach the volatility, right? Now, where can you find these bonds? Great question. You can find them in Treasury Direct right here. You just simply type in treasurydirect.gov and you can just come into individuals and find a list of available bonds. So here's a list of the upcoming options, 13 weeks, 26 weeks for, you have notes, you have bonds, you have tips, and when these are going to be auctioned. For those who want to get a little bit of insight as to what is the rate of return, here they are. They range from somewhere between 1.24, 1.65, all the way down to the zeros. And you can see over here how long they last. And this is their AD number. which is a QSIP, right? So a QSIP, it's kind of like the Social Security to help you identify the bond. So the technical term to identify them is the QSIP. Now, to give you more visibility, here is an article from Bloomberg that is showing the current rates on Treasury yields. So you have 1.64, 2.44. For those who don't know what yield means, it just simply means the interest rate or the return that they're offering you. You have TIPS over here as well, which are Treasury inflation protected securities. But keep in mind that the yield or the return in them are actually lower because you already are getting something more secure in comparison to what you're getting here. So remember, the more stable the bond is, the lower the return, and the riskier it is, the higher the return. And you got munis over here as well. And this is the return that they're offering right now. And if you're feeling a little bit more adventurous and you want to explore the return on corporate bonds, here you are. So this is a list of US corporate bonds rated AAA. And this is the value of what they're offering. So you got 3.88%, 3.97, 4.10, 4.14, yada, yada. And for those who are feeling even more adventurous, here's a list that I was able to pull out from Fidelity, where you can actually do a comparison of the return of something that is considered junk. So we have a description here of this company, Golub and Aircastle. Both are actually rated BBB minus. But then look at the yield. It's much higher in comparison to the other ones that we just saw. 3, 4. Now we're talking about 5.61, 5.466. Now back to the tablet. I want to address the topic of risk, right? Because I understand we are in very tumultuous time. There's a lot of drama going on in the market. Everyone keeps claiming that the world is going to end and yada, yada. And you might be wondering, how safe or how stable is it to invest in bonds, right? So if I were to make a comparison, and I'm going to come back to this table right here, think of bonds as, that boring partner, boyfriend, girlfriend, or, friends with benefits, whatever you want to call that person, who's stable, who doesn't have any drama. It provides you a stable source of income. That's what you get with a bond. And when you think about the stock market, that's kind of like that toxic partner that you had in the past or you're currently having right now. It's a lot of drama with this person. It's, it's not happy. But it gives you that sense of like, that you're living in an adventure. The more dramatic things are, the more adventures you're feeling. And that's the closest analogy I can think of. However, with that said, even with the relative stability of a bond in comparison to the stock market, that doesn't mean the bonds are risk-free. There is some level of risk involved into it. And that risk typically goes back to, am I going to get my money back, right? What's the probability of default? What's the probability that this company won't pay me back or that the government won't pay me back? So what I decided to do is do a little bit of research. I actually was looking into some numbers to see what was historically the chances of a bond defaulting. And here's what I found in Investopedia. So they did an analysis of all the bonds that were available in the market from the 1970s all the way to 2020. And they found that the average default, right, of munis was just 0.10%, 0.10. So relatively small. Very small in comparison to, companies that have been wiped out in the stock market. And if we were to talk about corporate bonds, the probability of them defaulting, it's only 2.25%. So once again, they're relatively safe. We are currently in unprecedented times and we need to readjust our investment strategy. It's no longer going to be an offense. We need to shift back our thinking process into something that is more on the defense mode. So that way you can protect your money from devaluing because of inflation. And once again, always educate yourself over and over again. I cannot emphasize that enough. And for those who are still looking for ways to educate yourself in real estate and learn about investing the right way, I invite you once again to check out this free webinar and I will see you over there. Take care. Bye-bye.